Nooresh, hi, good morning. Welcome on the show. And, just wondering, each time that you think that the index is in consolidation phase, comes that big move towards mid-session or so, was no different yesterday. I mean, come to think of it, we were, only 20 points away from the lifetime high once again?
So extremely positive price action yesterday. And overall, if we see it, we are waiting for a pause, a consolidation. It is not coming up. The whole market is not obliging. Everyone wants a dip because it's oversold. And the market does not oblige fully at such times. But the fact is at 19,400, 500 levels, risk reward for an index trade is off because there is a significant psychological resistance at 20,000. We have a lot of we have almost made a 600 pointer move after the recent breakout. So out here, the fact is the market strength tells you that the momentum is still strong. It is not getting into a consolidation mode. And in that case, what you do is prefer stock specific trades instead of the index. So the case is till the time we don't break any levels on the downside, the trend remains up. Whether we get into a consolidation or continue in an up move, both the cases are fine for a stock specific trading approach. So for now, 19,500, 600 is the resistance and 19,200 is the base. As we go higher, the base shifts higher. So the price action on the indices is pretty positive. You're seeing leadership come in few stocks. You have auto sector, which is doing well. You have Reliance Industries taking lead. And once after the next two sessions, we could get more clarity on HDFC Bank in terms of. So overall, the bias is positive. It's just that the risk reward is not great for an index trade. Time to continue to be stock specific and keep the bias on a positive trade.
All right. Given that you are looking at a very stock-specific strategy in the markets right now, I'm sure everyone's curious to know, Nooresh, what's on your radar?
So the first stock is a buy on Sun Pharma. The stock has crossed a 6 to 8 month high. And over the last 6 to 8 months, this is one of the stocks in the pharma space which did not correct as much when the whole pharma pack was correcting. Finally, the stock has taken leadership by crossing that 1070 mark, a new 52-week high for the stock, expecting this momentum to continue towards 1150 to 1200 levels in the short term. A stop loss to be placed at 1050. Second is a buy on Ashok Leyland. The stock has consolidated around this 170 mark for the last 1 year. 1 year back also the stock paused at 170, went back to 135, 140 levels, came to 170 a few weeks back, again dipped a little, and now we are in touching distance of that 170 mark. And then if you go a little backwards, you have the highs in 2018 at 170. So huge classical cup and handle formation in the making of the last 5 years. Now, once this breaks out, this should ideally give a move which could be trending, very similar to what has happened with auto stocks one by one, wherein say M&M was placed similarly at 1,000 rupees when it started making a new 52-week high. And we saw a nice uptrend over the next few months. So out here, Ashok Leyland is in touching distance. The stock was ex-dividend by 2.6 rupees recently, so very close to that 170, 73 mark. Expecting this to eventually break out and take leadership in the auto pack. A buy at current levels, add more on the way up above 170, 72. Stop loss to be kept at 161. A short-term target to start with of 190.
Okay, so those are the top recommendations coming in from Nooresh, but let's